Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The world of insurance is complex and specific to your situation, so it is absolutely essential that you consult with a qualified, licensed professional before making any financial decisions. Your insurance policy is a legal contract, and you are responsible for understanding its terms. He saved up for 2 years working a part-time job after school, bagging groceries and mowing lawns. The car wasn't new, but it was new to him. A 10-year-old Toyota Camry Silver, with a little over 100,000 miles. To 17-year-old Mark, it wasn't a car, it was freedom. It was the end of begging for rides, the end of waiting for the bus. It was the key to everything. There was just one final boss to defeat: car insurance. He sat at the kitchen table, laptop open, completely overwhelmed. Liability, collision, comprehensive, deductibles, bodily injury limits. It was a foreign language. His dad just said, "Get what's legally required, son. Find the cheapest deal you can." So that's what Mark did. He plugged his info into one of those big online comparison sites, and a dozen quotes popped up. He sorted them by price, lowest to highest. At the very top was a company he'd never heard of, offering a policy for just $110 a month. Felt like a steal. He clicked buy, printed the proof of insurance card, and threw it in his glove box, feeling like he'd just conquered the world. For 3 months, everything was perfect. Until a rainy Tuesday afternoon. He was coming home from school, maybe going a little too fast, and he didn't see the minivan in front of him stop suddenly. The screech of tires was followed by that sickening crunch of metal and plastic. Nobody was hurt, thank God, but the front of his Camry was crumpled, and the minivan's bumper was hanging off. Mark did everything right. He exchanged information, took pictures, and called his insurance company, a little shaken but confident. After all, he had insurance. He was covered. The agent on the phone was polite but firm. "Okay, Mark, I see you have coverage for the other vehicle. But for the damage to your own car, you have a $2,000 collision deductible." Mark went silent. $2,000? The repairs to his Camry were estimated at $2,500. That meant he had to come up with $2,000 out of his own pocket before his insurance would pay a single cent. He had about $300 in his bank account. That cheap $110 a month policy didn't just fail to save him. It had pushed him into a financial hole that would take him another year of bagging groceries to climb out of. His freedom machine was now a very expensive, stationary lawn ornament. This story, or a version of it, happens every single day to new drivers all across America. You pass the test, you get the keys, and you are so focused on the thrill of driving that you treat car insurance as just one last annoying checkbox to tick. And in that rush, you make the single biggest, most devastating mistake a new driver can make. You focus only on the price tag. You hunt for the lowest possible monthly payment, believing that cheaper is better. This video is your shield against that mistake. This is not a boring lecture about policy clauses. This is a survival guide. We are going to expose the hidden traps behind those deceptively low prices. We're going to arm you with the knowledge to see past the marketing gimmicks and understand what you are actually buying. By the time this is over, you will be able to get insurance with the confidence of a seasoned pro, securing a policy that genuinely protects you without getting ripped off. You will save yourself from the financial gut punch that blindsided Mark, and thousands like him. So let's get right into it. The number one mistake: chasing the lowest monthly premium. That monthly payment is the bait. It's the shiny lure that insurance companies dangle in front of you. They spend billions on ads with talking geckos and catchy jingles, all designed to make you focus on one number and one number only: how much you pay per month. But the true cost of your insurance isn't what you pay every 30 days. The true cost is what you're forced to pay out of your own pocket when something actually goes wrong. Think of it like this: buying insurance based only on the premium is like buying a smartphone based only on its price. You find one for $50. Amazing, right? But then you get it home and realize the battery lasts for an hour, the camera is blurry, and it can't even run the apps you need. You saved money, but you bought something that doesn't do the one job you needed it to do. Your car insurance is the same. A cheap policy that doesn't protect you in an accident is worthless. The reason that premium is so low is because of what's hiding in the fine print. And the first monster hiding there is the deductible. A deductible is the amount of money you have to pay out of pocket for a claim before the insurance company steps in and pays anything. In Mark's story, his deductible was $2,000. The damage was $2,500. So he pays his $2,000, and the insurance company covers the remaining $500. If the damage had been $1,900, he would have paid the entire amount himself. His insurance would have done nothing for him. When you get an online quote, the system will often default to a very high deductible, $1,000, $1,500, even $2,000, because it makes that monthly premium look incredibly low and attractive. They're betting that you, a new driver, won't crash. But statistics say you probably will have at least one minor accident in your first couple of years. Here is the golden rule for deductibles. Never, ever set your deductible higher than the amount of cash you have readily available in an emergency savings fund. If you don't have $1,000 you could comfortably part with tomorrow without going into debt, you have absolutely no business having a $1,000 deductible. A $500 deductible might raise your monthly premium by, say, $20 or $30. Yes, it costs more per month, but it also saves you from a $500 financial heart attack when you need it most. You are paying a little more for the certainty that a fender bender won't bankrupt you. The second trap hidden behind a low premium is dangerously low coverage limits. This is even more important than the deductible, because this is what protects your entire financial future. When you see a policy, you'll often see a set of 3 numbers like 25/50/25. This is your liability coverage. It means your policy will pay a maximum of $25,000 for bodily injury to one person, $50,000 total for bodily injury to everyone in the other car, and $25,000 for property damage, that is, to fix their car. This is the state minimum requirement in many places, and it is a financial time bomb. Let's be brutally honest. $25,000 for property damage is a joke in 2024. The average price of a new car in the United States is hovering around $50,000. What happens if you rear-end a brand new Ford F-150, or a Tesla, or even just a new Honda Pilot? The repair bill could easily be $30,000, $40,000, or $50,000. Your cheap insurance policy pays its max of $25,000, and then the other driver's insurance company turns to you for the rest. They will sue you, and because you're young and might not have assets, they will go after your future. They can get a judgment that allows them to garnish your wages for years. A significant chunk of every paycheck you earn could go to paying off a mistake you made when you were a teenager, all because you tried to save $15 a month on your car insurance. Getting state minimum liability is like going into a sword fight armed with a plastic butter knife. You are technically holding something, but you are not protected. You need to look at higher limits. Bumping your coverage up to 50/100/50, or even 100/300/100 might cost you less than a couple of pizzas per month, but it increases your financial shield exponentially. It is the single best investment you can make in your own future. So, the first step to being a smart insurance buyer is to completely change your mindset. Stop asking, what's the cheapest I can get? And start asking, what is the right level of protection that I can comfortably afford? Look past that shiny monthly premium. Dive into the details. Set a deductible you can actually pay. And choose liability limits that protect you from the reality of today's car prices and medical costs. This is the foundation. Getting this right puts you ahead of 90% of new drivers on the road. But this is just mistake number 1. The next mistake involves a massive misunderstanding of what your policy even covers, a myth sold by the term full coverage, and it can leave you stranded without a car, even when the accident isn't your fault. Let's talk about that term. Full coverage. Sounds so safe, so complete. It sounds like an impenetrable shield for your car and your finances. You walk into an insurance office, or more likely you go online, you click the box that says, full coverage. You pay your premium, and you drive away thinking, whatever happens, I'm covered. This belief is mistake number 2, and it's a catastrophic one. Because full coverage isn't a real insurance product. It's a slang term, a piece of marketing jargon that has duped millions of drivers into a false sense of security. There is no policy you can buy that is officially called full coverage. It's a bundle of different separate coverages, and what's included in that bundle can vary wildly. Worse, what's left out of that bundle is often the very thing that can financially ruin you. Let me tell you about a driver we'll call Jessica. Jessica just landed her first real job out of college. She saved up, made a down payment, and bought a beautiful certified pre-owned SUV. It was the nicest thing she'd ever owned. She was so proud. She did the responsible thing and immediately called to get insurance. She told the agent on the phone, "I want the best. Give me full coverage." The agent said, "You got it," quoted her a price, and she signed up. She felt like a real adult. Protected. Secure. 3 months later, She's sitting at a red light, singing along to the radio, when a pickup truck barrels through the intersection and T-bones her. The impact is violent. Airbags deploy, glass shatters. Thankfully, Jessica is okay, just shaken up and bruised. But her new SUV is totaled. A twisted wreck. The other driver, it turns out, was texting, clearly at fault. And as Jessica is standing on the side of the road, looking at the flashing lights, she takes a deep breath and thinks, well, at least I have full coverage. That's when her nightmare began. First, she discovers the driver who hit her has the absolute bare minimum insurance required by the state. His policy will only cover the first $10,000 of damage to her vehicle, her $30,000 SUV. Jessica thinks, no problem, my full coverage will handle the rest. She calls her insurance company. They tell her yes, her collision coverage will pay to replace the vehicle. But then comes the first blow. The other driver's insurance is responsible first, and dealing with them is a slow, painful process. While she waits, she needs a car to get to her new job. She calls her insurance again. Okay, so where do I pick up my rental car? The agent pauses. I'm sorry, Jessica, but you didn't purchase rental reimbursement coverage. Jessica is stunned. But I have full coverage. The agent explains, rental reimbursement is an optional add-on. It's not automatically included. Suddenly, Jessica is forced to pay $30, $40, $50 a day out of her own pocket for a rental for weeks, just so she can continue to earn a paycheck. That's over $1,000 she hadn't budgeted for gone. Finally, her insurance company finishes its assessment. They declare her SUV a total loss. They're ready to cut her a check. And here comes the second, more devastating blow. They tell her the actual cash value of her vehicle right before the crash was $26,000. But Jessica's car loan was for $30,000. She now owes her lender $4,000 for a car that no longer exists. This is called being upside down on your loan, and it's incredibly common. She pleads with the claims adjuster. How is this possible? I have full coverage. And for the third time, she hears the cold, hard truth. The coverage that would have paid off that $4,000 difference is called gap insurance. And just like rental reimbursement, it's an optional add-on. She was never offered it because she never asked. She just asked for full coverage. So now Jessica is in a financial black hole. She has no car. She's $1,000 in the hole from the rental. And she has to write a check for $4,000 to a bank for a pile of scrap metal before she can even think about saving up for a down payment on another car. All because she trusted a marketing slogan instead of understanding what she was actually buying. Jessica's story isn't an exaggeration. It happens every single day. So let's break down the myth. When an insurance company sells you a full coverage package, they are typically, at a minimum, bundling three core things. First, there's liability coverage. This is the part that's legally required in almost every state. But here's the key. Liability doesn't cover you or your car. It covers the other guy. If you cause an accident, your liability coverage pays for their medical bills and their car repairs. That's it. It protects your assets from being sued, but it does nothing to fix your own car. Second, they add collision coverage. This is the part that pays to repair or replace your car if you get into an accident with another vehicle or object, regardless of who is at fault. This is what would have helped Jessica, but as she learned, it only pays up to the car's depreciated value. Third, they add comprehensive coverage. This is for almost everything else besides a collision. If your car is stolen, if a tree falls on it in a storm, if you hit a deer, if it's vandalized, that's what comprehensive is for. So, liability plus collision plus comprehensive. That is the holy trinity that is almost always sold as full coverage. And while it's a decent foundation, it is not a complete fortress. It's a house with no doors and no windows. The real protection, the things that save you from Jessica's nightmare, are in the so-called add-ons. Think of it like buying a computer. The full coverage bundle is the tower, the monitor, and the keyboard. But you still need the software, the Wi-Fi adapter, the webcam, and the surge protector to actually make it work for your life. The insurance add-ons are not frivolous luxury items. For many people, they are absolute necessities. Let's look at the ones Jessica desperately needed. Rental reimbursement. This coverage is usually dirt cheap. We're talking a few dollars a month. For the price of one fancy coffee, you can get a policy that will pay for a rental car for up to 30 days. When you consider that the average collision repair can take 1 to 2 weeks, and a total loss claim can take even longer, this small expense saves you from a massive unexpected bill. Gap insurance. If you are financing or leasing a new or newish car, this is non-negotiable. Cars depreciate the second you drive them off the lot. In your first year, your car could lose 20% of its value. But your loan balance doesn't drop that fast. Gap insurance pays the difference. It fills the gap between the cash value your insurance company gives you and the amount you still owe the bank. Without it, you could be making payments on a ghost. And what about the other driver? The one who hit Jessica who had terrible insurance? That's where uninsured or underinsured motorist coverage comes in. It's shocking, but the Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. That's over 30 million people. If one of them hits you and injures you, they have no insurance to pay your medical bills. This coverage steps in and acts like the at-fault driver's insurance, covering your medical expenses and sometimes even lost wages. It protects you from someone else's irresponsibility. The mistake isn't wanting to be fully covered. The mistake is assuming a vague marketing term will do it for you. You have to be your own advocate. You have to build your own full coverage by specifically asking for the individual pieces that fit your life. Do you have a car loan? Ask for GAP. Can you not afford to be without a car for 2 weeks? Ask for rental reimbursement. Do you live in a state with a lot of uninsured drivers? You absolutely need uninsured motorist coverage. Stop saying, "I want full coverage." Start saying, "I want to see a list of all available coverages, and I want you to explain what each one of them does." This single shift in language can be the difference between a minor inconvenience and a financial catastrophe that sets you back for years. You've now sidestepped the 2 biggest landmines for new drivers: picking an insurer on price alone and falling for the myth of full coverage. You're already way ahead of the curve. But there's another, more subtle trap waiting. It's a choice you make about a single number on your policy, a number that dictates how much money you have to pay out of your own pocket before your insurance even kicks in. Most new drivers set this number way too high to save a few bucks a month, without realizing they're setting themselves up for a massive immediate financial hit when they can least afford it. This is the deductible trap, and we're breaking it down next. So let's talk about that $1,000 deductible. Or maybe it's $1,500, or even $2,000. It looks so tempting on the insurance quote website, doesn't it? You drag that little slider to the right, and you watch your monthly payment drop. $10, $20, $50 a month. Feels like you're winning. It feels like you just discovered a secret life hack to get cheap insurance. But what you've actually done is arm a financial time bomb and set the timer for the day of your very first accident. A deductible, in the simplest terms, is the part of the bill you have to pay yourself before the insurance company even opens its wallet. Think of it as your buy-in for a claim. Let's say you have a $1,000 deductible for collision coverage. You swerve to avoid a squirrel, you hit a guardrail, and the repair estimate for your car is $4,000. You are on the hook for the first $1,000. You pay that directly to the body shop. Only after you've paid your share will your insurance company step in and pay the remaining $3,000. If the damage was only $900, congratulations, your insurance company owes you nothing. You pay the entire bill yourself, even though you've been dutifully paying your premium every single month. The trap is that new drivers, who are almost always on the tightest budgets, are the most likely to be seduced by the promise of a lower monthly bill. They see that high deductible as a hypothetical problem for a future that might never happen. They think, "I'll be a safe driver. I won't get into an accident." But the monthly savings? That's real money right here, right now. It's an extra pizza night, it's more gas in the tank, it's a little less financial stress every month. The insurance website is designed to encourage this thinking. It presents it as a simple choice. Pay less now. Who wouldn't choose that? But let's play the movie forward. You're 6 months into your first policy. You chose the $1,500 deductible and you've saved, let's say, $30 a month. That's $180 in your pocket. You feel smart. Then one rainy Tuesday afternoon, you're in stop-and-go traffic. The car in front of you slams on its brakes, and you just can't stop in time. It's a low-speed crunch. No one is hurt, thank God, but your bumper is crumpled, your headlight is shattered, and your hood is bent. You do everything right. You exchange information, you take pictures, you file a claim. A few days later, the adjuster calls. "Good news," he says. "The car is reparable. The total cost will be $3,800. Now your policy has a $1,500 collision deductible, so we'll need you to pay that to the shop, and we'll cover the remaining $2,300. And in that moment, the world stops. Your blood runs cold. $1,500. You have to produce $1,500 right now, or you can't get your car fixed. The $180 you saved over the last 6 months suddenly feels like a joke. It's monopoly money compared to the real cash you have to come up with immediately. Where does a new driver, maybe a student or someone working their first full-time job, get that kind of money on a Tuesday? Do you have it in your checking account? Do you have it in savings? For most new drivers, the answer is a hard no. So what are your options? You could put it on a high-interest credit card, instantly adding hundreds of dollars to the cost in the long run. You could make the humiliating call to your parents asking for a bailout. Or, and this is the most devastating option, you do nothing. You can't afford the deductible, so the car sits. If it's not drivable, you're suddenly without transportation. How do you get to your job? How do you get to class? Your entire life, your independence, the very reason you bought the car in the first place, is now held hostage by a decision you made 6 months ago to save $1 a day. You might be forced to keep driving a damaged, potentially unsafe car, just to stay employed. This is the deductible trap. It doesn't just cost you money. It can derail your entire life at the precise moment you're most vulnerable. So how do you avoid it? It's simple. You follow the golden rule of deductibles. Never, ever set your deductible for an amount higher than what you have sitting in an emergency fund, ready to go, at a moment's notice. I don't mean money you need for rent, or money you're saving for a vacation. I mean a dedicated oh crap fund that you could withdraw today without breaking a sweat. If you have $500 in your emergency savings, your deductible should be $500. Period. End of story. If you have $1,000, you can consider a $1,000 deductible. Your deductible should be a direct reflection of your financial reality, not your optimism about being a perfect driver. Because perfect drivers still get hit by imperfect ones. Good drivers still slide on black ice. You have to find the sweet spot. A super low deductible like $250 might be overkill, making your monthly premium unnecessarily expensive. But a super high one like $2,000 is just playing Russian roulette with your finances. For most people, the sweet spot is somewhere between $500 and $1,000. And think about the math. Let's say raising your deductible from $500 to $1,000 saves you $25 a month. That's $300 a year. Sounds good. But to realize those savings, you are taking on an additional $500 of risk. You would have to go almost 2 full years without a single at-fault accident just to break even on the risk you've assumed. And for a new driver, who is statistically at the highest risk of having an accident in their first 2 years on the road, that is a terrible, terrible bet to make. You are betting against the house, and the house has all the data. So I want you to do something right now. Pause this video, pick up your phone and open your insurance app. Or go find your policy declaration page in your email. Look for 2 words, collision deductible and comprehensive deductible. Look at the number next to them. Is it $500? $1,000? $2,000? Now ask yourself one brutally honest question. If you got into an accident on the way home today, could you write a check for that amount without it causing a full-blown financial crisis in your life? If the answer is no, you need to change it. Today, call your agent or go online and lower that deductible to a number you can actually afford to pay. Yes, your monthly premium will go up slightly. It might cost you an extra $15 or $20 a month, but that's not a cost. That's an investment. It's the price you pay for peace of mind. It's the price of ensuring that one bad moment on the road doesn't send your entire life into a downward spiral. Fixing your deductible is a massive step. It protects your wallet when you need it most. But here's the scary part. That deductible only matters if you actually have the right type of coverage to begin with. And this is where millions of new drivers make an even costlier mistake. They fundamentally misunderstand the 2 most critical coverages that protect their own car. They think they're covered for a disaster like a tree falling on their car, when in reality, they only have coverage for hitting another vehicle. It's the classic catastrophic mix-up between collision and comprehensive, and getting it wrong can mean your insurance pays you absolutely nothing, leaving you with a totaled car and a full car loan to pay off. And that financial nightmare leads us directly into the 4th, and arguably the most devastating, mistake a new driver can make. It's a trap that feels smart, feels responsible. It's the choice that saves you the most money up front. And it's the one that has the power to completely ruin your financial life before it even begins. I'm talking about choosing state minimum liability coverage. Let's be honest. When you're a new driver and you're looking at that insurance quote, your eyes are immediately drawn to the lowest possible price. You see an option for $60 a month, and another for 90. You think, I'm a safe driver. I'm not going to cause a huge pileup on the interstate. Why would I pay $30 extra a month for something I'll never use? So you click the button for the cheapest option, the state minimum. You've just made a catastrophic error. To understand why, let me tell you a story about a hypothetical new driver. We'll call Jessica. Jessica is 20. She's a great student, works a part-time job, and saved up for 2 years to buy her first car, a nice, reliable used sedan. She's incredibly proud of it. When it's time to get insurance, she does what she thinks is the smart, frugal thing to do. She sees that her state requires a minimum of $25,000 in property damage liability and $50,000 in bodily injury liability. Perfect. She signs up, gets her insurance card, and feels like a responsible adult. She's saving about $40 a month compared to the higher coverage options. That's gas money. That's a few lunches. Feels like a win. 6 months later, Jessica is driving home from a late class. It's raining, the roads are slick, and it's dark. She's stopped at a red light. She gets a text from her mom. For just 1 second, one single solitary second, she glances down at her phone to read it. In that 1 second, her foot relaxes just a little on the brake, and her car creeps forward, bumping the car in front of her. It's a low-speed tap. No big deal, right? Wrong. The car she just tapped is a brand new Mercedes-Benz S-Class. The driver gets out. He's a partner at a downtown law firm. The tap cracked his high-tech rear bumper, which is full of sensors for the backup camera, blind spot monitoring, and parking assist. The initial estimate to replace and recalibrate everything is $22,000. Jessica breathes a sigh of relief. Her state minimum property damage is $25,000. She's covered. But then the final bill comes in. After hidden damage was found, and factoring in the cost of a luxury rental car for the lawyer while his was in the shop for 3 weeks, the total bill is $31,000. Jessica's insurance company writes a check for $25,000, the maximum they are legally obligated to pay. The law firm's insurance company then sends Jessica a bill, personally, for the remaining $6,000. Suddenly, Jessica's entire savings account, the one she was building for her future, is gone. Wiped out. All because she tried to save $40 a month. But it gets so much worse. Let's change the scenario just slightly. Let's say instead of a gentle tap, Jessica was going 30 miles an hour and rear-ended the lawyer's Mercedes, causing a more serious accident. The lawyer and his wife in the passenger seat both suffer serious whiplash and back injuries. They aren't life-threatening, but they require months of physical therapy, chiropractic visits, and pain medication. They both have to miss work. Remember, Jessica's bodily injury liability limit was $50,000. That sounds like a lot of money until you see how quickly it evaporates. The lawyer's initial medical bills are $30,000. His wife's are $28,000. That's a total of $58,000 in medical bills alone. Jessica's insurance pays out the full $50,000. Now she is personally on the hook for the remaining $8,000 in medical costs. But we're not done. The lawyer and his wife also sue for lost wages. He missed 2 months of work, losing $60,000 in income. She missed 3 months, losing $20,000. That's another $80,000. And then they sue for pain and suffering, which the court awards them another $50,000 for. Let's do the math. We have $8,000 in remaining medical bills, $80,000 in lost wages, and $50,000 in pain and suffering. Jessica, the 20-year-old student who tried to save $40 a month, is now personally facing a judgment of $138,000. This is not a scare tactic. This is not an exaggeration. This happens every single day in America. A judgment like that is a financial death sentence. The insurance company of the people she hit will come after her with everything they have. They can garnish her future wages, meaning a percentage of every paycheck she ever earns will be taken from her until the debt is paid. They can seize her assets. Any money she has in the bank is gone. Her car is gone. Her credit score is obliterated for a decade, making it impossible to get a loan for a car, an apartment, or a house. She is, for all intents and purposes, financially ruined before she even had a chance to start her life. All to save the price of a pizza once a month. So what's the solution? It's simple. You need to understand that state minimum liability is a trap. It's a legal loophole that allows you to drive, but it offers virtually zero real-world financial protection. The sole purpose of liability insurance is to protect your assets and your future from a lawsuit when you cause an accident. The state minimums in most states are so laughably low they haven't been updated in decades. They don't reflect the reality of modern car repair costs or modern medical expenses. When you buy insurance, you'll see liability limits written as 3 numbers, like 50/100/50. Here's what that means. The first number is the maximum amount, in thousands, that your insurance will pay for bodily injury to a single person in an accident you cause. In this case, $50,000. The second number is the maximum amount they'll pay for bodily injury for all people combined in that accident. In this case, $100,000. The third number is the maximum they'll pay for property damage. That's the other person's car, or if you hit a mailbox or a building. Here it's $50,000. Most financial experts and insurance professionals will tell you to never, ever carry less than 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for injuries in an accident, and $100,000 for property damage. That is considered the bare minimum for responsible financial protection in today's world. If you can afford it, $250/500/100 is even better. And here's the kicker. The difference in price is almost always far less than you think. Going from a dangerously low state minimum policy to a much safer 100/300/100 might only cost you an extra $20 to $30 a month. You are trading the price of 2 fancy coffees for hundreds of thousands of dollars in protection. It is the single best investment you can make in your own financial security. You are not buying insurance for the other person. You are buying it to protect yourself from them. So when you get that quote, ignore the state minimum. Ask your agent to quote you at 100/300/100 and at 250/500/100. Look at the small monthly difference and understand that you are buying a shield to defend your entire future. Don't be like Jessica. Don't let a $40 decision lead to a $100,000 catastrophe. But even if you get your liability limits right, there's another number on your policy that can come back to bite you just as hard. It's a number you choose yourself, and most new drivers pick the wrong one every single time, thinking they're saving money when they're actually setting themselves up for a massive unexpected bill. That number is your deductible, and it's probably the single most misunderstood part of any insurance policy. On the surface, it seems so simple. When you're getting a quote online, you see a little slider. Slide the deductible up, your monthly payment goes down. Slide it down, your payment goes up. For a new driver staring at a screen trying to make that monthly number as small as humanly possible, the temptation is overwhelming. You see a $2,000 deductible saves you, say, $30 a month compared to a $500 one. Your brain does the quick, flawed math. Wow, I'm saving $360 a year. I'm a genius. You crank that deductible all the way up, click buy, and feel like you just hacked the system. But you didn't hack the system. The system just hacked you. Let's be crystal clear about what a deductible is. It is the amount of money you have to pay out of your own pocket for a repair before your insurance company contributes a single penny. It's your share of the risk. When you choose a $2,000 deductible, you are making a legally binding promise to your insurance company. You are saying, in the event of an accident where I use my own collision or comprehensive coverage, I solemnly swear that I can and will produce $2,000 in cash on the spot to cover the first part of the bill. Does that sound like a promise you can keep right now? Let me tell you about a guy we'll call Mark. Mark just turned 19. He worked all summer to save up for his first car, a clean 5-year-old Honda Civic. It was his pride and joy. He was responsible. He wanted to do everything right. So he shopped around for insurance. The quotes were high, as they always are for new young drivers. But then he found the deductible slider. He saw that by choosing a $2,500 deductible, his premium dropped to something that felt manageable. He thought, I'm a safe driver. I'm not going to get into an accident. I'll just be careful, and I'll save all this money. He was focusing on the $40 a month he was saving. For 6 months it worked perfectly. He paid his bill, drove carefully, and felt smart. The extra $40 a month was his gas money, his pizza with friends money. He was winning. Then one Tuesday afternoon he was parked at the grocery store. He came out with his groceries and found his heart in his stomach. Someone had backed into his car hard. The rear bumper was smashed, a tail light was shattered, and the trunk was dented. And of course there was no note. A classic hit and run. Mark was furious, but he thought, okay, this is what I have insurance for. He called his insurance company, filed a claim, and took the car to a body shop. The next day, the shop called with the estimate. The total cost for the repair was $4,000. Okay, Mark said. Just let me know when my insurance approves it. The guy at the shop paused. Well, they approved it, he said. But you know you have to pay your deductible first, right? We can't start the work until we receive your payment of $2,500. Silence. Mark's blood ran cold. $2,500? He didn't have $2,500. He had maybe $300 in his checking account. The money he'd saved up all summer had gone into buying the car itself. The $40 a month he'd been saving for the past 6 months added up to a measly $240. He was $2,260 short of the amount he had legally promised his insurance company he could pay. Suddenly, his cheap insurance was the most expensive thing in his life. His car, his freedom, the thing he worked so hard for, was now undrivable. It sat at the body shop collecting dust, while Mark scrambled, embarrassed and panicked, trying to borrow money from his parents. The stress was immense. The feeling of failure was crushing. All to save $40 a month. This story plays out every single day. New drivers are, by definition, inexperienced. Not just at driving but at managing financial risk. They are optimistic, and they believe a crash won't happen to them. But insurance isn't for when things go right. It's for the one moment when it all goes wrong. And your deductible is the price of admission to get help in that moment. Let's break down the gamble you're taking. Let's say that $2,500 deductible saves you $40 a month over a more reasonable $500 deductible. That's a difference of $2,000 in out-of-pocket risk. To save up that $2,000 difference from your monthly savings of $40, you would need to go 50 months without a single at-fault accident or incident where you need to use your coverage. That is over 4 years. 4 years of perfect driving, perfect luck, and no one ever hitting your car in a parking lot. No deer jumping out on a country road. No hailstorm, no vandalism. Are you willing to bet you can go 4 years without a single incident just to break even on that risk? And remember, most new drivers have at least one minor claim within their first 2 years on the road. The odds are fundamentally, mathematically, stacked against you. So what is the right way to choose a deductible? It's not a trick question. The answer is brutally simple. Your deductible should be an amount of money you have sitting in a savings account right now that you could withdraw tomorrow without it causing a financial crisis. If you have $1,000 saved up for emergencies, you can consider a $1,000 deductible. If you only have $500, then you must choose a $500 deductible. Do not choose a deductible based on the monthly premium it gives you. Choose it based on the cash you actually have on hand. Think of it this way: the premium is a small, predictable bill. The deductible is a massive, unpredictable bill that could arrive at any moment. You need to be prepared for the big one, not just the small one. Ignoring this is like building a house with no fire extinguishers because you want to save a few $100, telling yourself, "I'll just be careful not to start a fire." It's a foolish gamble. And the consequences go beyond just the money. For Mark, it meant weeks of stress, awkward conversations with his family, and not having his car. What if he needed that car for a job? Or to get to college classes? The savings from his high deductible plan could have cost him his job or a semester of school. The true cost of a bad insurance decision is never just the dollar amount. It's the disruption, the stress, and the loss of freedom. So, when you get that quote, resist the siren song of the super low monthly payment. Look at that deductible slider not as a savings tool, but as a personal risk meter. Slide it to a number that honestly reflects the size of your emergency fund. If you don't have an emergency fund, your first financial goal isn't to get the cheapest insurance. It's to save up $500, put it in a separate account, and set your deductible to match. That is financial maturity. That is true security. You've now sidestepped the landmine of liability limits and navigated the treacherous waters of the deductible. You've built a policy that actually protects you. You're paying a fair price for real coverage, and you're feeling confident. But now comes a mistake that isn't made at the start, but one that quietly creeps in over time. It's a trap baited with convenience and a false sense of security. A trap that punishes loyalty and costs good drivers a fortune by making them believe they're getting a deal when they're actually being taken for a ride. The most insidious part of that trap is that it works even if you never file a claim. You can spend years, even a decade, paying for a service you don't fully understand, bleeding money month after month simply because you don't know what questions to ask. This brings us to the single most fundamental and financially devastating mistake a new driver can make: not understanding the 3 shields of car insurance. See, most new drivers think of car insurance as a single monolithic thing. You either have it or you don't. But that's like thinking a knight's armor is just one big piece of metal. In reality, it's a complex system of interconnected plates, each designed to protect against a different kind of attack. Your insurance policy is the same. It's not one shield, it's three. And if you don't know what each shield does, you're walking into battle with massive, gaping holes in your defense. The first shield is liability coverage. This is the big one, the one that's legally required in almost every state. But here's the critical misunderstanding that costs people their life savings. Liability coverage does absolutely nothing for you or your car. Let me repeat that. It does nothing to fix your vehicle. It does nothing to pay your medical bills. Liability coverage is for the other guy. It pays for their car, their property, and their medical expenses when an accident is your fault. It is a shield that protects your assets from being seized in a lawsuit. You're not buying it to protect your car. You're buying it to protect your future from being destroyed by a legal judgment against you. And this is where the state minimum trap snaps shut on millions of drivers. You'll see your state requires something like a 25/50/25 policy. Sounds official, it sounds sufficient. It's the law after all. But do you know what those numbers mean? 25/50/25 means your insurance will pay a maximum of $25,000 for a single person's bodily injury, a maximum of $50,000 for all bodily injuries in a single accident, and a maximum of $25,000 for property damage. Now take a deep breath and look around you. The average price of a new car in America is now over $48,000. Do you see the problem? Your $25,000 property damage shield doesn't even cover the cost of replacing a brand new Toyota Camry, let alone a BMW or a Ford F-150. If you cause an accident that totals a new truck, your insurance pays the first $25,000, and guess who's getting a bill from the other driver's lawyers for the rest? You are. And that's just the car. A multi-day hospital stay with surgery can easily soar into the six figures. Your $50,000 bodily injury limit would be a drop in the bucket. Just meeting the state minimum is like bringing a garden hose to a house fire. It's legally compliant, but financially suicidal. That's shield number one. Protects everyone else from you. The second shield is the one most people think they have. It's called collision coverage. This is the shield that protects your car. This is the coverage that pays to repair or replace your vehicle when you are at fault in an accident involving another object. Notice the wording, another object. That's usually another car, but it could also be a guardrail, a telephone pole, a garage door you misjudged. If you are moving and your car makes impact, collision is your shield. Let me tell you about a guy named Kevin. Kevin was 19, just got his first real job, and bought a used but pristine-looking Honda Accord. He was so proud of it. He did the responsible thing and bought insurance. To save money, his agent suggested he just get liability. Kevin thought, great, I'm a safe driver, I'll be fine. 6 months later, on a wet autumn night, he took a turn a little too fast. The car hydroplane spun out and slammed backward into a concrete median. Kevin was thankfully okay, just shaken up. But the rear of his car was completely destroyed. The frame was bent. It was a total loss. He called his insurance company, expecting them to guide him through the process of getting his car replaced. And then he heard the words that made his stomach drop. The agent on the phone said, "I'm sorry, Kevin, but your policy only has liability coverage. We can pay for the damage to the city's median, but we can't do anything for your car." In that single moment, Kevin's $12,000 investment vanished. He had no car to get to his new job, and he still owed thousands on a car loan for a vehicle that was now a twisted heap of metal in a junkyard. He had the shield to protect the concrete wall, but no shield to protect himself. He made the mistake of thinking insurance meant his insurance. He didn't understand he'd only bought half the armor. That brings us to the third and final shield, comprehensive coverage. This is the most misunderstood shield of all. If collision is for when your car hits something, comprehensive is for almost everything else. Think of it as the act of God or bad luck shield. This is what protects you if a tree branch falls on your car during a storm. This is what protects you if a deer decides to use your front grille as a shortcut. This is what covers you for theft, vandalism, fire, flooding, and hailstorms. It's for all the chaos the world can throw at your car that has nothing to do with you actually driving it into an object. You might think, what are the chances of that happening? But every year, hundreds of thousands of cars are stolen. Millions of drivers hit deer. Hailstorms cause billions in vehicle damage. Without the comprehensive shield, every single one of those owners is on their own. They wake up to find an empty parking spot where their car used to be. And the insurance company's answer is, sorry, not our problem. So you have liability, the shield for others; collision, the shield for your car in a crash; and comprehensive, the shield for your car from the world's random cruelty. When you have all three of these, that's what people usually call full coverage. But you need to know that full coverage is just a slang term. It's not an official product. It's a bundle of these three shields. The mistake isn't necessarily foregoing one of these shields. If you drive a 20-year-old beater worth $800, you probably don't need to pay for collision or comprehensive. The catastrophic mistake is not understanding what each shield does, and driving around thinking you're protected when you're actually one patch of black ice, one distracted moment, or one falling tree branch away from financial ruin. So right now, I want you to pull up your own insurance policy on your phone. Look at the declarations page. Find those three words: liability, collision, and comprehensive. Are they all there? Do you know the limits for each one? Because knowing what your shields are built to do is the first step in surviving the financial war zone of the open road. But even with the right shields in place, there's a hidden number buried in your policy. A self-destruct button that you agree to when you sign up. It determines whether a small claim is a minor inconvenience or a major crisis that drains your bank account. It's called your deductible, and the way most new drivers choose it is a masterclass in financial self-sabotage. Let's look at this from the insurance company's perspective. They are a business, a very, very profitable business built on statistics and risk. They know that a certain percentage of new drivers will get into an accident. It's not a matter of if, it's a matter of when and how bad. The deductible is their first line of defense. It's the barrier they erect to filter out the small, annoying, and frequent claims. It's the price of admission you have to pay to get to the real benefit of your policy. Think of it like a cover charge at a club. You can't just walk in and start ordering drinks. You have to pay at the door first. Your insurance is the same. You can't just have a fender bender and expect them to start writing checks. You have to pay your cover charge, your deductible, first. And here is where the trap is laid, and it's a beautiful, seductive trap. When you're getting a quote online, you see that little slider for your deductible. It might start at $250 or $500. Then you slide it to the right, $1,000. And you watch in real time as your monthly premium, that number you actually have to pay, drops. Magically, you slide it further, $1,500, $2,000. The premium plummets. Your brain, wired for instant gratification, lights up. You think, wow, I can save $30, $40, even $50 a month just by clicking this button. I'm a safe driver. I'm not going to get in an accident. Why would I pay a higher premium for a low deductible I'll never use? This is the single most common and most dangerous calculation a new driver makes. You are making a bet. You are betting a large lump sum of cash, say $2,000, that you won't need in an emergency against a small guaranteed monthly savings. And for a little while, you feel like a genius. You're saving $400 a year. You're beating the system. Then one Tuesday afternoon it happens. You're in stop-and-go traffic. You look down for a split second to change the song on your phone. Just a second. But when you look up, the brake lights on the SUV in front of you are blazing red and they are not moving. You slam the brakes, but it's too late. The crunch of metal and plastic is sickening. Your airbag doesn't go off, but your heart feels like it's trying to beat its way out of your chest. Nobody's hurt, thank God. But your hood is buckled, your headlight is smashed, and your brand new car looks like it lost a fight with a can opener. You do everything right. You exchange information. You take pictures. You call your insurance company, your voice still shaking. The agent on the other end is calm, professional. They walk you through the process. You get a tow truck. You get a quote from the body shop. The estimate comes back, $3,700. You take a deep breath and call your insurance agent back. Okay, you say. The estimate is $3,700. And the agent says the words that will echo in your nightmares. Great. Once we receive proof that you've paid your $2,000 deductible to the body shop, we'll cover the remaining $1,700. And in that moment, the world stops. $2,000. The $50 a month you save feels like a joke. A cruel, cruel joke. You don't have $2,000. You have maybe $400 in your checking account, and rent is due next week. You thought having insurance meant you were covered. You thought you were protected. But what you actually had was a coupon for a discount on a catastrophe you couldn't afford in the first place. Now what? Your car is undrivable. You can't get to your job. You can't get to class. You have to call your parents humiliated and ask for a loan. Or you have to put it on a high-interest credit card, turning a one-time payment into a multi-year debt sentence. That $50 a month you saved has now cost you thousands in interest, stress, and broken trust in yourself. You sabotaged your own financial well-being for the price of a few fancy coffees a month. This is the classic mistake. Choosing a deductible you cannot comfortably afford to pay today in cash. But there's a flip side to this coin. A mistake that's less dramatic but just as financially inefficient. It's the mistake of being overinsured. This is the driver who is so terrified of the scenario I just described that they choose the lowest possible deductible, say $250, and pay a significantly higher premium for it. Month after month, year after year, they pour extra money into the insurance company's pockets for a level of protection they may never use. If you're a safe driver with a healthy emergency fund, paying an extra $400 a year just to have a lower deductible is like paying for a fire extinguisher made of solid gold. It works, but you're paying way too much for the peace of mind. So what is the answer? How do you find that perfect sweet spot between reckless gambling and wasteful spending? Comes down to one simple, unbreakable rule. The golden rule of deductibles. Never, ever choose a deductible that is higher than the amount of money in your dedicated emergency fund. I want you to do something right now. Pause and look at your bank account. Not your checking account that you use for bills and groceries. Look at your savings. The money you have set aside for a true emergency. How much is in there? Be brutally honest with yourself. If that number is $700, then your deductible should be, at the absolute maximum, $500. Period. No exceptions. If your emergency fund is $3,000, then you have the financial freedom to choose a $1,000 deductible and enjoy the lower premium that comes with it. Your deductible should not be a goal. It should not be an amount you think you could come up with by selling your video games and borrowing from friends. It must be an amount you could pay on the spot without blinking, without derailing your entire financial life. This creates a clear, actionable strategy for you. Step 1. Assess your reality. Look at your emergency fund. Step 2. Choose your deductible based on that reality, not on wishful thinking. Step 3. Make a plan to climb the deductible ladder. As you build your savings, you earn the right to increase your deductible. When you first start out, maybe you can only afford a $500 deductible, and your premium is a little higher. That's okay. You focus on building your emergency fund. Once you have $2,000 saved up, you can confidently call your insurance company, raise your deductible to $1,000, and instantly lower your monthly bill. You've now used your financial discipline to give yourself a raise. You've turned your deductible from a source of anxiety into a reward for responsible saving. This single shift in perspective, from seeing your deductible as a way to save money on your premium, to seeing it as a direct reflection of your emergency savings, is the key to unlocking financial security as a driver. It protects you from the catastrophic mistake of being underinsured, while also preventing you from needlessly wasting money by being overinsured. It puts you, not the online quote tool, in control of your financial fate. So you've picked the perfect deductible. It's aligned with your savings and you feel secure. You're protected, right? Not so fast, because choosing the right deductible is only half the battle. The other half is knowing what that deductible actually applies to. And most new drivers are paying for a type of coverage that sounds essential, but is often a complete waste of money, while simultaneously skipping the one coverage that could save them from total financial ruin. Let's start with that coverage that sounds essential but is often a total waste of money. It goes by a few names, but most commonly it's called rental reimbursement or transportation expense coverage. On the surface, it makes perfect sense. If your car is in the shop after an accident, your insurance company will pay for a rental car. It usually only costs a few extra bucks a month, so what's the harm? Well, those few bucks a month add up to $50, $60, maybe $70 a year. Over 5 years, that's $350. Now, ask yourself a few honest questions. If your car was out of commission for a week, do you have another way to get around? Could you borrow a family member's car? Could you work from home? Could you use public transportation or a rideshare service? For many people, especially students or those living in a city, the answer is yes. The cost of a few Uber rides is almost certainly less than what you'd pay for this coverage over several years. And here's the kicker. The coverage itself is extremely limited. It doesn't just kick in whenever your car is in the shop. It only applies if the repairs are for a covered claim under your comprehensive or collision policy. So if your transmission just dies of old age, this coverage does nothing for you. And even when it does apply, it has a strict daily limit like $30 or $40 a day, and a maximum total like $900. In today's market, $30 a day might not even cover the taxes and fees on a rental, let alone the car itself. So you're paying every single month for a highly restrictive benefit you might never use, and which might not even fully cover your costs if you do. Before you add this, check your credit card benefits. Many premium cards offer rental car perks. Check with your dealership, they might offer free loaner cars for service. Don't pay for something you might already be getting for free. Now let's talk about the other side of that coin. The one coverage that new drivers skip that can lead to absolute, life-altering financial ruin. I'm talking about uninsured and underinsured motorist coverage, also known as UM and UIM. In some states it's required, but in many it's optional. And when given the option, a new driver looking to save money sees uninsured motorist, thinks, well, I have insurance so I don't need that, and they uncheck the box. This is, without a doubt, one of the most catastrophic financial mistakes a person can make. Let me paint you a picture. Imagine you're driving home one night. You're doing everything right. You approach a green light and suddenly a car blows through the red light and T-bones you. It's a violent, terrifying crash. You wake up in a hospital. You have a broken leg, a concussion, and internal injuries requiring surgery. Your brand new car, the one you saved up for years to buy, is a twisted wreck, a total loss. The police report is crystal clear. The other driver was 100% at fault. So, you think at least their insurance will cover everything. But then you get the call. The driver who hit you has no insurance at all. They were driving illegally. Suddenly that word uninsured isn't about them anymore. It's about you. Who pays for your $100,000 medical bills? Your health insurance might cover some, but what about your massive deductible? Your co-pays? The physical therapy you'll need for the next year? Who pays you for the months of work you're going to miss while you recover? Who replaces your $25,000 car? Without uninsured motorist coverage, the answer is simple. You do. The person who hit you has no insurance and likely no assets. You can sue them, sure, but you can't get blood from a stone. You're left with a mountain of debt, no car, and a long, painful recovery, all because someone else broke the law. That is what uninsured motorist bodily injury and uninsured motorist property damage coverage protects you from. It is your insurance company stepping in to play the role of the at-fault driver's insurance that doesn't exist. It pays for your medical bills, your lost wages, your pain and suffering, and it pays to repair or replace your car. Think it's rare? The Insurance Research Council estimates that 1 in 8 drivers in the United States is uninsured. That's more than 12%. In some states like Mississippi and Florida, it's over 20%. Every time you're on the road, there's a very real chance the car next to you has no coverage. Now let's look at the second part. Underinsured motorist coverage. This is just as important. Let's go back to that same accident. But this time the at-fault driver does have insurance. The problem is they bought the cheapest plan legally allowed. In many states, the minimum liability for bodily injury is only $25,000 per person. Your medical bills alone are $100,000. Their insurance pays out its maximum of $25,000, and that's it. They're done. You are still left with $75,000 in medical bills, plus your lost wages, plus your totaled car. You are underinsured. This is where underinsured motorist coverage saves you. It kicks in after the other driver's insurance runs out, covering the difference up to the limits you selected. It bridges the gap between their pathetic coverage and your actual costs. So what's the mistake? The mistake is either rejecting this coverage entirely or, just as bad, choosing low limits to save a few dollars. The rule of thumb is simple and non-negotiable. Your uninsured and underinsured motorist coverage limits should be an exact match for your own bodily injury liability limits. If you have chosen to protect other people from financial harm with $100,000 of coverage, you absolutely must give yourself that exact same level of protection. Do not leave this to chance. While we're on the topic of coverages that protect you, let's quickly touch on 2 others: medical payments or MedPay and personal injury protection or PIP. These are often confused, but they're designed to pay for your medical expenses after an accident, regardless of who was at fault. This is crucial because a fault decision can take weeks or months. MedPay and PIP pay out right away, so you can get the care you need without waiting. It can cover your health insurance deductible, ambulance rides, dental work, things your health plan might not cover well. If you have a high deductible health plan, or no health insurance at all, these coverages are not just important, they are a lifeline. Finally, there's one more optional coverage that is critical for new drivers with a new car: gap insurance. If you are financing or leasing your car, you need to listen very carefully. The second you drive a new car off the lot, it depreciates. It loses value. A year later, you might owe $25,000 on your car loan, but the car's actual cash value, what an insurance company will pay you if it's totaled, might only be $20,000. If your car is totaled in an accident, the insurance company will write you a check for $20,000. You then have to turn around and give that entire check to the bank, but you still owe them $5,000. You are now making monthly payments on a $5,000 debt for a pile of scrap metal that doesn't exist anymore. That $5,000 is the gap. Gap insurance is a cheap, simple policy that pays off that difference so you can walk away from the loan completely free and clear. Some dealerships will try to sell you this for an inflated price, but it's almost always cheaper to add it directly to your auto insurance policy. If you have a car loan, do not skip this. So you see, building the right policy isn't about getting the most coverage, it's about getting the right coverage for your specific situation. You need to stop thinking of these as just checkboxes on a website and start thinking of them as tools to build a financial fortress around your life. But even with the perfect set of coverages, most new drivers are still leaving a fortune on the table. They're eligible for discounts they don't even know exist, and they're falling for a psychological trick that insurance companies use to make you think you're getting a great deal when you're actually being overcharged by hundreds, sometimes thousands of dollars a year. This psychological trick is a classic sales tactic known as price anchoring, or sometimes the decoy effect. And once you see it, you can never unsee it. Imagine you're at the movie theater. A small popcorn is $7. A large popcorn is $8. Which one do you buy? Almost everyone buys the large. For only $1 more, you get way more popcorn. Feels like an incredible value. But what if the options were different? What if the small was $7 and the large was $12? Suddenly, that $7 small looks a lot more reasonable. The large now seems expensive, and many people would just stick with the small. What happened? In the first scenario, the theater owners didn't really want to sell you the small popcorn. They created a third option, a medium popcorn for $7.50. Now the choices are small for $7, medium for $7.50, and large for $8. The medium is the decoy. Its only purpose is to make the large look like an unbelievably good deal. It's priced so close to the large that your brain screams, just get the large. It's only 50 cents more. Insurance companies do the exact same thing. They'll present you with a quote that has 3 tiers. Tier 1 is the state minimum liability. It's the cheapest, but they'll make it sound terrifyingly inadequate. They'll say things like, this only covers the other person and only up to $15,000. One small accident could bankrupt you. Then they'll show you Tier 3, the platinum or diamond package. It has absurdly high coverage limits, rental car reimbursement, roadside assistance you probably already have, custom parts coverage, and a price tag that makes your eyes water. Let's say it's $300 a month. And then, right in the middle is Tier 2, the gold or recommended package. It's priced significantly lower than the platinum package, maybe at $200 a month, but it seems to have most of the important stuff. Compared to the scary bare-bones option and the outrageously expensive platinum option, this middle one feels safe, smart, and like a good value. You've been anchored by the high price of the platinum plan. That $300 a month decoy makes the $200 a month plan feel like a bargain. But here's the secret. The right combination of coverages for you might have only cost $170 a month. They use the decoy to trick you into spending an extra $30 a month, which is $360 a year, without you even realizing it. You walk away feeling like you got a deal, when in reality you were masterfully upsold. The solution is to ignore their prepackaged tiers. You build your policy a la carte. You decide on your liability limits, you decide on your deductibles, and you decide which add-ons you actually need, based on your own situation, not based on their manipulative pricing structure. But even after you've sidestepped that trap, you're still likely leaving money on the table. The real savings, the deep cuts to your premium, come from stacking discounts. These are discounts that most agents won't proactively offer you. They won't ask the right questions. You have to know they exist and you have to ask for them by name. This is where you can save hundreds, even over $1,000 a year. So let's build your discount checklist right now. We'll break them down into 3 categories. Discounts based on who you are, discounts based on what you drive, and discounts based on how you behave. First, who you are. The most famous one for new drivers is the good student discount. But most people don't know the specifics. This isn't just for high schoolers. It often extends to full-time college students up to age 25. The typical requirement is a 3.0 GPA or a B average. If you qualify, this can be a huge 10 to 25% discount. Before you even call for a quote, have a copy of your most recent report card or college transcript ready to send over. Don't just mention it, prove it. Next is the away at school discount. If you're a college student who is going to a school over 100 miles away from home, and you are not taking the car with you, you are a much lower risk. The car is just sitting in your parents' driveway most of the year. This can slash the premium significantly during the school year. Then there's the affinity discount. This is one of the most underutilized discounts in the entire industry. Insurance companies partner with thousands of organizations, employers, and associations. Are you or your parents a member of a credit union like Navy Federal? Are they a member of an alumni association, a fraternity or sorority, a professional organization for teachers, engineers, or nurses? Are they active or retired military? Are they a member of a wholesale club like Costco? All of these can unlock a special discount, often in the 5 to 15% range. You need to literally make a list of every organization, club, and employer your family is associated with and ask the agent, do you have an affinity discount for any of these? Now for the second category. Discounts based on what you drive. Your car itself is a treasure trove of potential savings. Start with safety features. Don't just say your car has airbags. That's standard. You need to be specific. Does it have anti-lock brakes, ABS? Electronic stability control? ESC? Daytime running lights? These are all common discounts. But what about newer features? Blind spot monitoring? Lane departure warning? Automatic emergency braking? Make a list of every single safety feature your car has. The more you can list, the more tiny discounts you can stack. Next, anti-theft devices. Again, be specific. Is it a passive device, meaning an engine immobilizer that works automatically without you doing anything? Or is it an active device like a car alarm you have to arm? Do you have a vehicle recovery system like LoJack installed? Each of these can be a separate discount. And here's one that sounds backward: the new car discount. If your car is less than 3 years old, you can often get a discount. The logic is that newer cars are more reliable, less likely to break down, and have the most modern safety features, making you a lower risk to the insurance company. Finally, the third category, discounts based on how you behave as a customer. These are the easiest ones to get. First, the simple ones: paperless billing and automatic payments. Agreeing to get your bills by email and having your payment automatically deducted from a bank account proves you're a reliable, low-maintenance customer. Each one might only be a small $5 a month discount, but it's free money. Next is a big one: the paid-in-full discount. Insurance companies hate monthly payments. There's a risk you might miss one, and they have to spend money on processing 12 separate transactions instead of one. If you can afford to pay your entire 6-month or 1-year premium up front, they will often reward you with a substantial discount, sometimes as much as 10 to 15%. On a $2,000 annual premium, that's an instant $200 savings just for paying differently. Then there's the defensive driving course discount. States have a list of approved traffic school or defensive driving courses, many of which can be completed online in a single weekend. If you voluntarily complete one of these and send the certificate to your insurance company, it can knock 5 to 10% off your premium for 3 straight years. It's an investment of a few hours that pays you back multiple times over. And the king of all discounts, bundling. This is the multi-policy discount. Now, as a new driver, you might not have renters or homeowners insurance, but your parents do. If you live at the same address, you can almost always bundle your auto policy with their home or renter's policy. This doesn't just give you a discount, it gives them a discount too. It is by far the biggest discount you can get, often saving 25% or more on the total insurance bill for the entire family. So you've dodged the psychological traps, you've armed yourself with a checklist of over a dozen discounts. You're ready to get the cheapest rate possible, right? Wrong. There is one final critical mistake that can undo all of this hard work. It happens after you get the quote, right before you pay, and it's a mistake that can leave you financially ruined after an accident, even if you have what you think is full coverage. It's the single most misunderstood part of any insurance policy, and in the final part of this series, we are going to break it down completely. It's the 3 numbers on your insurance policy, usually separated by forward slashes. You've seen them. Maybe they're 25/50/25, maybe 50/100/50, or maybe 250/500/100. Most new drivers, and frankly most drivers in general, either have no idea what these numbers mean, or they have a dangerously incorrect understanding of them. They think it's just insurance jargon. It's not. These three numbers represent the absolute heart of your financial protection. They are your liability limits, and understanding them is the single most important thing you can do to protect your entire financial future. Let's break it down number by number. The first number is your bodily injury liability limit per person. Let's say your number is 25, which stands for $25,000. If you cause an accident and injure someone in another car, this is the maximum amount your insurance company will pay for that one person's medical bills, lost wages, and pain and suffering. One person, $25,000. Does that sound like a lot of money? A single night in a hospital and ambulance ride, and a few x-rays can easily exceed that amount. A broken leg requiring surgery can cost $50,000 or more. If you hit someone and their medical bills are $40,000, but your limit is $25,000, your insurance company writes a check for $25,000, wishes you the best of luck, and walks away. You are now personally legally on the hook for the remaining $15,000. And that's just the beginning. The second number is your bodily injury liability limit per accident. Let's say that number is 50 for $50,000. This is the absolute maximum total your insurance will pay for injuries to everyone in the other car, combined. It doesn't add on top of the first number. The first number is a cap within this second number. So if you have 25/50 limits and you hit a car with 3 people in it, your policy will pay a maximum of $25,000 to any one of them, but no more than $50,000 for all of them combined. Imagine you cause a minor fender bender, but it's a minivan with a family of 4 inside. They all get checked out at the hospital for whiplash and observation. The bills come in: $12,000 for the driver, $15,000 for the spouse, $10,000 for the first kid, and $9,000 for the second. The total is $46,000. Because that's under your $50,000 per accident limit, and each individual's bill is under your $25,000 per person limit, you're covered. But what if one of them needed surgery? What if the driver's bill was $30,000? Your insurance would pay $25,000 for them, and then cover the rest of the family up to the remaining $25,000 limit. You would be personally sued for the $5,000 difference on that first person's bill. This is how quickly a seemingly minor accident can spiral into financial disaster. The third number is your property damage liability limit. This is the maximum your insurance will pay to repair or replace whatever you hit. The other person's car, a fence, a storefront, a city light pole. Using our 25/50/25 example, that third number means your policy will pay a maximum of $25,000 for all property damage you cause in a single accident. Now look around you the next time you're on the road. The average price of a new car in the United States is now nearly $50,000. You see Tesla's new Autos big pickup trucks everywhere. What happens if you slide on some ice and hit a brand new Ford F-150? The repair bill could easily be $30,000. Your insurance pays $25,000. The other driver's insurance company will then come after you, personally, for the remaining $5,000. And they will get it. They can garnish your wages, put a lien on your property, and destroy your credit for years. You're just starting your life, and you could already be thousands of dollars in debt from one single mistake on the road. This is the trap. It's called buying state minimum coverage. Every state has a minimum amount of liability insurance you are legally required to carry to register your car. And for many states, those minimums are terrifyingly low, like 25/50/25 or even less. Insurance companies will happily sell you this coverage because it gives you the lowest possible price. It makes their quote look incredibly attractive. But you have to understand what state minimum insurance is for. It is not designed to protect you. It is designed to meet the legal requirement to drive. It's a system designed to provide at least a small amount of compensation to the people you might hit. It is the bare minimum, and the bare minimum is a financial gamble you cannot afford to take. Remember in the last part when we talked about full coverage? This is where that term becomes so dangerous. You might have comprehensive and collision, which protects your car. You might think you're fully covered, but if you have state minimum liability limits, you are massively exposed. You have a tiny little shield protecting you from a world where a single lawsuit can be financially fatal. A serious accident that you cause, one where someone is permanently injured, can easily result in a lawsuit for hundreds of thousands or even millions of dollars. Your $50,000 liability limit is a drop in the ocean. They will take everything you have. And they will take a percentage of everything you earn for decades to come. Your future is mortgaged because you tried to save a few dollars a month. I'm telling you this not to scare you, but to empower you. Because here is the single greatest secret in the car insurance industry. Increasing your liability limits is the cheapest, most effective way to buy yourself immense financial protection and peace of mind. The difference in premium between a risky state minimum policy and a much safer policy like 100/300/100 is often shockingly small. We're talking about the price of a few cups of coffee or a Netflix subscription per month. For maybe $20 or $30 extra a month, you can increase your protection by hundreds of thousands of dollars. There is no other financial product in the world that gives you that kind of leverage. You are trading pocket change for a fortress of protection around your future. So here is your final mission. The most important action you can take after watching this entire series. Right now, I want you to pull up your insurance policy on your phone app, or find your paper declaration page. Look for those 3 numbers. If they are the state minimums for your state, your top priority is to change that. Call your agent or go online and get a quote to raise your limits to at least 100/300/100. If you can afford it, go for 250/500/100. The cost to do this will be far, far less than you think, and it could be the single most important financial decision you make all year. Ask them to quote you the difference. See for yourself how little it costs to buy real protection. And for those of you who want to go to the next level, ask about an umbrella policy. This is an extra layer of liability coverage that sits on top of your auto and home insurance. For a few $100s a year, you can add an extra $1 million or more in protection. This is what protects you from that catastrophic, life-altering lawsuit. It's the ultimate safety net. You've made it. 10 parts. You've learned about deductibles, coverages, discounts, and the dangerous myths the industry is built on. You are no longer just a new driver when it comes to insurance. You are now an informed consumer. You know the right questions to ask, you know how to spot the traps, and you know how to build a policy that doesn't just make you legal, but actually makes you safe. You now know more than 90% of the drivers on the road. Use that knowledge. Protect yourself. Protect your future. Your future self will thank you for it.